Right now, the absolute largest, highest conviction position in my entire portfolio is Amazon. But if you look at how the market reacted to them recently, you'd think the company was in trouble. Investors panicked when management announced a staggering $200 billion allocation toward capital expenditures. This chart shows exactly why traders got spooked. CapEx spending is shooting straight up, while free cash flow is dropping deep into the red. On the surface, it looks like a dangerous cash burn. Algorithmic traders and short-term investors see those falling cash levels, assume it means a loss of efficiency, and immediately hit the sell button. But what they are reacting to is an accounting illusion. That temporary dip in cash isn't a symptom of failure, it's a coiled spring. Even famous market skeptics routinely miss the mark here. They focus entirely on the 24-month accounting drag and ignore the actual physical assets being built in the background. Wall Street's inability to look past the current cycle has created a massive mispricing opportunity for anyone looking at the long-term reality. To see Amazon's plan, look at macro demand. Here is an $810 billion AI data center market nestled inside a $4.6 trillion digital infrastructure push. Industries are desperate for physical compute power. That concentrated slice is where money flows into the ground. The cloud computing cash cycle is unique. Providers pay for the land, the power lines, and the servers months before they can bill a single customer. But Amazon isn't laying out cash on a hunch. They already have legally binding, pre-sold commitments from giants like OpenAI that require massive compute capacity. Management has explicitly confirmed that they are monetizing this new server capacity exactly as fast as they can physically install it. They aren't building data centers and hoping for the best. They are executing guaranteed contracts that practically eliminate demand risk. While the physical buildings get all the headlines, the real margin story is inside the servers, where Amazon is vertically integrating its hardware. The market consensus assumes that external hardware manufacturers hold a total monopoly on the profits from this boom. This chart shows the scale of Amazon's custom silicon, already at a $20 billion internal run rate. If sold to the public like a traditional provider, annual revenue would approach $50 billion. Plus, these in-house chips offer 40% better price performance than the industry baseline. By designing and building their own silicon, Amazon completely bypasses the massive markups they used to pay out to external chip makers. Amazon is sitting on a $50 billion chip powerhouse that isn't even on the books yet. By cutting out suppliers, they keep those profits for themselves, saving tens of billions of dollars every year. Which brings us back to the math. Analysts are confusing a short-term cash outlay with the actual useful lifespan of these assets. Look at this timeline. The cash goes out over a short, intense 6 to 24-month window, but those same servers will generate recurring revenue for 5 to 6 solid years, and the data center real estate itself will continue generating value for over 30 years. We are approaching a tipping point in the next 18 to 24 months. The initial build-out phase will stabilize, and revenue growth will finally overtake the spend. When that happens, the accounting drag disappears, unleashing an avalanche of free cash flow, larger than almost any other company on Earth. Buying Amazon today is buying tomorrow's toll road for the AI revolution, while it sits at a steep temporary discount. Investors who trade short-term accounting noise for long-term reality will secure a piece of an impenetrable cash flow monopoly.